And of course, nothing happens without George. So, you know, that's the only part of it. But, you know, real quick, I will introduce our speaker. We're very, very fortunate to have him here. We asked him to do it on short notice, and you know, he's flying to the center, and thanks to Dave and to bring him here. So I'm going to read the quick bio I have of him, you know, and then I'll take it from there. So Ulice Payne Jr. is the president and managing member of Sassafras, a licensed wholesale distributor of BP and ExxonMobil proprietary gasoline and motor fuel products. He founded the company in 2007 with his partners Burgess Colbert and the late NBA legend Maurice Lucas. Payne is also president of Addison-Clifton, a firm which provides global trade compliance advisory services. He served on numerous corporate boards. Ulice has extensive leadership Payne, previously serving as the president and CEO of the Milwaukee Brewers from 2002 to 2003, and as a managing partner of the Milwaukee office of Foley and Lardner, a Milwaukee law firm. He's an alumnus of Marquette and lives in Donora. He's a native of Donora, Pennsylvania. He's married with 2 children. So, Ulice, thank you so much for doing this.
Morning, everybody. Thank you, John. Appreciate it. So I'm going to watch my time. How much do I have? 20 minutes, 15 minutes? I want to make sure. Okay, I keep going. I'm scheduled for 20, so I'll probably use 25. So again, I want to thank you all for being here, and for the director, Castillo, for your presence here today. It means a lot to everybody, and of course to the Chicago North Park Development Council, my friends there who were a member of the council, and they've been very supportive of our efforts in the motor fuel business, and I'll talk a bit about that. But I'd encourage you all to utilize the resources right downtown there, because the reach is long and the heart is deep. So I just encourage you, if you haven't done it already, please seek to be members of the council and be supportive. So as Hans said, I'm a lawyer by training, and I've been fortunate in that I've had a chance to run some businesses that weren't my own. Managing lawyers like, you know, herded cats, they're your partners, but they don't listen. I had a chance to sit on probably 6 corporate boards, sit on 3 now, public boards, over my time. I'm also an entrepreneur, so I'm going to give you my perspective today on this very key issue about access to capital and maybe a way to look at it, because I've seen it from different levels, I guess, on that vertical canvas. Capital, you know, a big part of that is in America and in the world. As they say, there's no romance without finance. So you have to bring the money. And one thing I learned too, there's never enough money. So the question is, you know, what do you want versus what do you need? And so going back as a lawyer, as an entrepreneur, as the head of CEO of a big company, the key question is, you know, what do you need first? And then what do you want? And from one thing I've seen over the years, and I experienced it ourselves in our business, is you don't always know what you need. You think you know what you need. But that needle moves. And the problem with when you try to build access capital from someone else, the first number you give them is the number they remember. Right? So if you say, I need, you know, $50 million to start the business, you can't come back 6 months later and say, I need $52 million. So keep that in mind, right? It's always easier, it's hard to go back, right? So the key is, what do you need versus what do you want? Second, the environment. Keep that in mind. As we all know, we're creatures of our environment, and capital flows where it is welcome and it stays where it's well treated. So in this environment, on a macro basis, right, you look at the world economy, you say, well, the United States, you know, we took our medicine first. The Great Recession, we took the medicine first. The Europeans were in denial. They even talked about raising interest rates 2 years ago. Crazy, okay? The environment is that it's slow growth, Slow growth means stimulation by the central banks, which means keeping rates low, keeping the pipeline full of cash. Like Director Castillo said, the money's out there, okay? And they just can't figure out how to earn on that money. So the governments, the United States government, European Central Bank, look at what happened in Japan. Japan was too slow to move. Japan has been in a deflationary environment for 20 years. They're like at negative growth rates. And in our country, the Federal Reserve says we're not going to let that happen. We're going to keep interest rates low for a long time. When we raise interest rates, when we see inflation, we want inflation. Inflation means the economy is growing pretty quickly. So right now, the environment that we're in is a good environment for need capital because the pipeline is flush with cash. Okay, and the world economy, again, Europe's in trouble. I sit on board of Manpower Group. We're in 82 countries. We just hire people. We know the pulse on the street, and so the U.S. is the place for everybody to go. As a result, interest rates stay low here because people are pushing their money to us. And as a result, banks and others don't have to put much of an interest rate or rate of return on their investments because people have to come. People are coming. So it's a good thing, I think, for those who need capital. Second thing about the environment, though, is, as usual, when you need money, you can't get money. So they say, my parents used to tell me, make friends before you need them. Okay. Don't all of a sudden get close with the banker when your money's tight. He really don't want to talk to you. So keep that in mind. And forecast out, when will you need money? How much will you need? And need is different than wants. So give you a couple examples. Our fuel business. I'm a lawyer by training, customs lawyer by training. My primary business is really my trade consulting firm. We do global trade compliance work for companies like Sikorsky Aerospace, United Technologies, GE Power, Harley-Davidson. That's what we do. I got a chance 7 years ago. I got a call on my way going to China, where we have an office there for 10 years. And my phone was ringing, going through the security. You put your phone in the bin, it comes out the other side, and it's ringing. I picked it up. It's a friend of mine named Ramesh Kapoor. Ramesh was an engineer in Milwaukee, Wisconsin. I actually represent his wife, who's an anesthesiologist, and a lot of her friends, about 17 of the doctors. And he said, Ulice, would you be interested in buying some gas stations? I said, no. And he said, where you at? So I'm in the airport heading to China. He says, well, can I talk to you more? Well, call me when I get to China. So he called me and explained to me that basically in the fuel industry, we got Steve Hightower here from Hightower Petroleum, and the other guys in the industry, there's a vertical. There's exploration, refining what they find, wholesale distribution, and retail distribution of motor fuels. And that's what we're at the gas station level, right? That's what we all do. So ExxonMobil, BP, Shell, they all used to own the whole vertical. So they actually, they explored for it, they refined it, they sold it on a wholesale basis, and they distributed it to the stations that they own. So the Amoco dealer really was an employee of Amoco. So they had the whole vertical. But they decided for a lot of reasons, primarily the crack spread at the refinery. It was better to make money at the top level than the bottom level. Especially when the price of crude went over, 30, 40 bucks a barrel, they said, we're going to make the money up there. The reason is, the top of the vertical, it's hard to build a refinery. Yeah, it's a big person's game at the top. So they decided to sell the downstream, wholesale distribution, retail distribution. Again, environment. This was the time we didn't push it, it was happening, market forces were bringing it, and more importantly, the consumer decided, I want to go into my gas station, I want to buy a latte in a Wall Street Journal, and get a brushless car wash, right, and swipe my payment at the pump. So Bitcoin decided, we don't want to invest down there. We're going to stay up here, we're going to sell the downstream. So, they came to, I got the call because that summer, ExxonMobil was going to sell Detroit. And it was learned that basically there were no African-American distributors of the whole 500-person distribution network in the United States. And the folks in Detroit were upset about it. They'd come to Chicago, and that's how I got the call. So my point is, environment. The environment was right for us to get this business. Second thing, 2006, 2007, economy's going great. We're rolling, right? I mean, we're rolling in the economy. So people were making investments. There was excess return for them to make investments. Okay, so we went to get the money from JP Morgan Chase, who's my personal banker who banked our Addison-Clifton, our consulting business, and we knew nothing about the business. So one way that we had to get the capital was I had to show them that I knew about the business. I had to show them I had the ability to run two businesses. Okay, but get to know this business. So I went to class at ExxonMobil Center for Retail Excellence, spent a lot of time on there. ExxonMobil had a 75 square mile ranch, all fenced in, where, the boys go to play. So I go down to the ranch and they teach me about the business, which allowed me to show JP Morgan Chase that I knew the business. So time to capital. Capital candle, right? Generally you start out with equity. You go to quasi-equity, preferred, return, then you go to debt. So if you can do it, you probably want to get as much equity as possible. So it was mentioned in the introduction, I had two friends, Burgess Colbert, and one of my lifetime friends, Ulice, who passed away 4 years ago now. I said, look, I got some equity, we get the debt, but I don't want too much debt. Okay, because one thing again about the banks, they'll give you money when you don't need it. The fact they were offering me the money says, maybe I don't need it. So it's like, you know what, I'm not sure I want all that debt. So our first transaction was about a $20 million transaction. And typically you had to put up 25-30% in that. We put up more. The more we offered to put up, the more Chase wanted to give us. Right? Very interesting. So he said, okay, I tell you what, we don't need your money now. We'll take a line of credit. So I don't want the money now, but if I need the money. So that's what we did. We put a lot of equity in, we got some debt, and more importantly, got a line of credit to grow the business. So if you think about financing excess of capital, again, think about the needs. The vision is acquisition needs, operational needs, and growth needs. So again, when you go to ask for the money, you have to anticipate all of those needs. What I've seen often is we're so eager to get the business and get the money, we just go for the acquisition needs. What's it take to get into the business? And once we get in, we realize, you know what, I need money to run the business. And once you find out you need money to run the business, you say, well, how am I going to get money to grow the business? So if you talk about that whole need that finance can, think of that. Acquisition, operations, and growth. As a matter of fact, for the banks, you have to talk about banks, they want to invest in business that's growing. In other words, loaning you the money, $10 million a day, they say, I want to loan you 15, 20, because that lender, any lenders in the room here, they get paid on giving up the money. All right? They can't get a return unless they put the money out. So they really do want to give you the money. Okay? So it's important to remember, you say, I got to make sure I can show them I'm going to grow. Oftentimes that's missed in the conversation, and you really kill it. You say, I want the money to buy the business. I say, yeah, okay, well, how am I going to get it back? I'm going to get it back by you growing your business. So if you can't demonstrate to me how you plan to grow your business and how you're going to finance that, it's in trouble. Now, people finance the growth through accounts receivable, factoring, things like that. Get expensive money, typically. And you're counting on your customer to pay you on time. Okay? And sometimes we know customers don't always pay on time. So you think about that capital vertical, acquisition, operations, and growth. Next thing to think about is some lessons learned. We bought BP Mobiles in February of 2007, and we bought 18 BPs in March of 2009. Because again, the whole industry is sold. Here in Chicago, Metro Chicagoland, all the 300-some sites of BP have been sold. All the mobile sites have been sold, all the Shell sites have been sold to what they call distributors like us, right? So We did the BP deal, '09. By the way, '09, think of your environment, cloudy days. '09, President Obama just took office. Every day the stock market's going down. Okay, financial institutions closed. So again, to close on March 31st, 2009, and JP Morgan Chase said, here's the 20 million, I told you we had a pretty good deal. Because at that time, they weren't returning calls. So, '09, we closed, now we have this business. We make basically 6 cents a gallon. We do 35 million gallons. I have 4 people. Our revenue is $104 million. And all of a sudden, ExxonMobil knocks on the door again and says, Ulice, we're going to sell all of Chicago. You bought a portion of it before, now we're going to sell all of it. The guys who want to sell it to couldn't get the deal done. Can you do it? Now again, I was bringing in my stomach and said, of course. Shoot, took the right plan. So the deal was 81 sites. It roughly was, we bid $104 million. Big deal. About 168 million gallons. Okay, and one thing about the fuel business, again, we like this space, you don't want to have to advertise and generate sales. People have to market, generate sales. It's very competitive, but you find a lot of volatility. Like the funeral director, the healthcare business, they don't have to advertise much for sales. Right? That's what you want. How many doctors advertise? Not a lot. Some. But if we talked earlier, when you go to a cardiologist, you will ask them how much it costs. You want that kind of business, right? But they don't ask you how much it costs. Well, the fuel business is the same way. People have to buy gas. Okay? And in Chicago in particular, Amoco, which was there before BP, Amoco made sure that on the 4 corners of a city, that only there's one Amoco station. A lot of places you'll see 2 and 3 corners of gas stations. In Chicago, Amoco locked it up. So you're going to buy our gas. I bet you bought my gas today. So if you think about the business, my point is, you want a business where people have to buy. So ExxonMobil sold the whole market, $104 million. We signed the deal. August, September of '09. Now we go looking for the money. Well, we go back to JP Morgan Chase and they ask for this kind of big. Okay, how are you going to grow the business? Talk to other banks too. Realize, you know what? It's a pretty expensive deal till we get this done. Long story short, we spent $500 million trying to get the deal done. We talked to other distributors, bigger than us. Found out we had to sell some of the assets to be able to finance the deal. Bad deal. Okay, so although we spent $500 million to find out we couldn't do it, it was the best $500 million that we spent. Okay? Because we found, again, that in that environment, '09, tough. On the numbers, looks good. Great real estate, good brand, great business. But that environment, tough. So when you think about when you need what you need, when you need it, think about the environment that you're in. The director said, hey, the money is available. Okay? But you know what? Credit standards are tough. So when the money's available, standards are tough. So understand that when you go in and try to work with the business. So I guess the moral of that story is, they say, sometimes the greatest blessing is an unanswered prayer. We wanted that business so bad, I was going to church regularly. But the best thing happened was that we didn't get that prayer answered. Okay, because now, again, I didn't like that. That was a lot of debt. Okay, we found ourselves in a position where it was tough to do. So I told my partner, we spent $500 million, and now we're going to walk away. It's the best thing we could have. Okay? So, I got 5 minutes. Okay, good, okay. Another thing I want to talk about in terms of as an entrepreneur, again, as a lawyer and as a director of a company, there's something that we call confirmation bias. We all have it. Okay? And you got to give a quick example. I serve on the board of Northwestern Mutual, and I'm on the finance committee, and we have we're about a $200 billion business. And in assets, we have $220 billion. And we get free cash flow of $1.4 billion every month to invest from our premiums we get from our policy owners. So we get free cash of $1.4 billion. And there was a time where, again, every week the market's going down. We meet the third Monday of every month, and we get to presentations. And it was tough because the money you invested last month is not worth less this month. But yet you got another $1.4 million, you got to invest anyway, right? So it tests your convictions. And I mention that to you because sometimes you find yourself in a situation where no matter what you try to do, the market's going against you, right? You go and you give presentations of your financials to your bank, and they all look great, and for 3 months it's running well, the fourth month, boom, it fell off the table. Now all of a sudden the fourth month and the fifth month, it's off the table. Okay, what happens oftentimes we get jittery, right? And I said, where's your conviction? The same when it comes to money, because your bank is saying, by the way, I thought your projection said X, and now you're at Y. How come you, and you need money now, but says I can't give you more money because you didn't meet your projections. And one of the reasons why sometimes we're slow to act on this is because it's something called confirmation bias, where many times the TV stations we watch, the people we hang out around, the newspapers we read, are those newspapers and TV stations that say the things that we already believe. We want to hear it again. Like my wife, she won't watch Fox News. She won't. I said, well, you should at least listen to what they're saying. Because you might hear something that you won't think of on your own. We won't do that. Listen to the same station, read the same newspaper, and we do it. That's called confirmation bias. So we say, nothing's wrong with my business. I'm looking at my numbers, I don't understand why they won't give me the money. Because we see we're talking to ourselves. Okay? We're confirming our own biases. That's the toughest thing to do. So and as an entrepreneur and as a lawyer representing clients, to go get the money, you say, you got to avoid the confirmation bias. Sometimes the banks do too. Like in our industry, the fuel industry, banks generally see, look, banks like, man, oil and gas, it's just an alarm, I think. Is that yours? Sorry, I was trying to make sure I didn't go too far. 1 minute, I'm going to wrap it up. So again, the confirmation bias, I just suggest that we all have that. We do. And because you kind of hear the same things all the time, you see the same projections all the time, you wrote it, so you believe it, right? And I think, if anything, we have to walk against that. You know, try to find the opposite view, right? Try to see someone who doesn't know much about it, okay, give you that other perspective. Because oftentimes you go look for the money, that's what you're going to do. You're not going to buy the story. Because I've never seen projections that didn't look great. Right? Everybody has one. Okay? So you say, well, okay, well, let's flip it over. You know, where are the holes? Figure that out before you can win, because that's basically what your winner's going to do. Last thing I'm going to say is equity partners, because I had 2 friends in the business. In my recent past, again, 58 years old, picture health, played in the NBA for 20 years, was coaching, and had bladder cancer. And it felt fine until the day he finally had. So he passed in about a year, which is tough for us, because we were looking to grow the business for our families. My other partner, Burgess Colbert, who's 73, different stage of life, we kind of did this for our children. And when you talk about partners, though, I never had a business where my wife's my partner. My Addison-Clifton firm, I'm 99, she's 1%. But in this case, I was 60 and Burgess and Maurice were 20. But my wife, I'm president, my wife really directs operations, she runs it every day. I mean, I'm pillow talk, you know, board meeting, but she runs it every day. And to have partners who are your friends is a challenge. I can tell you, sometimes that's you go for the money because you know them, but it's a challenge. Because equity is risk capital. And for some reason, people forgot that equity is risk capital. Okay? And one of the other parts about bringing in equity capital is sometimes in the bank, they want the equity owners to guarantee. It's harder to get someone to guarantee something that they're not in the business. Right? They give you, you know, $500,000, but to guarantee a loan for $12 million, that is whole. Okay? So when you talk about equity partners, I mean, it's good to do it, but again, it's a business decision. Sometimes it's hard to distinguish over the course of that relationship, when it's business versus when it's a personal relationship. And if you can get it on your own, I suggest you do that. The second, I'll leave you with this. Don't be afraid to walk away from the money. I know we got some money people here, who say the money's good, smells good, looks good, but they only make it to you, give it to you because that's how they make their money. Sometimes, you know, you got to find a way not to take the debt financing, invest in yourself. I often find that's a key factor, right? If you're not willing to invest in yourself, it's hard to get other people to invest in you. Last thing I would say is, again, be aware of the environment. So right now, rates are low, capital is available, get more than you need. Say, you know, make hay when the sun shines, they say, get more than you need. They could always say, and sometimes it happens in negotiation, I want 100 million, so I ask for 120. Okay? That's okay. As long as you can show that you can still make it on 100. Right? Because oftentimes, again, you can't go back. Once they close and all the documents are done, it is so difficult to go back and open up those documents and give you another $5–10 million because they set their mark on their return based on what they're going to do. So I appreciate your time and attention. I'm not sure if I helped you or not, but hopefully that's my perspective. Okay? And I look forward to working with you in the future. Thank you.